It's been a long time since I had you on the show, so I'd love to get your take on the roller coaster ride silver has been on from around $30 at the start of last year to a close of over $116, a new all-time high at the end of January this year, subsequently crashing 26% in a single trading day, currently hovering around $73 an ounce. What do you make of this price action? And do you think we make new all-time highs in 2026?
Well, the short answer is yes. And we'll get into the longer answers. Of course, again, I always have to caveat I'm selling my book, but a lot of us in the space are very bullish on silver. And of course, we have a bias. And of course, we have a conviction. I think when you're talking about silver, whether you're talking about any commodity or we're talking about precious metals, it's a different answer depending on the audience, depending on what kind of investor they are, whether they're swing trading or they're traders or they're long-term investors, they're wealth preservationists. What is their time horizon? Is it a month, a quarter, a trading day, an hour? Is it 20 years? So it's a different answer depending on who's listening in a sense. But of course, at Von Greyerz, we're purely wealth preservation. We've been that for decades, and that's not going to change. We understand silver as the mama metal is gold and the baby metal is silver. It has a much better beta when gold's on a bull run. But we look at silver and gold as monetary metals, and we look at them as wealth preservation tools. And so our horizon is many, many years. So I have to caveat by saying that, because I think if you're trading or arbitraging or spread trading it, even the best traders I've seen in this space, I know a lot of them aren't very successful because there is a lot of volatility based on headlines and price moves in commodities in general, and silver in particular, with all the mechanizations in the COMEX market starting in 24, which I've written about a lot. But I think at 30,000 feet, keep it simple, stupid, because we understand it as a simple long-term play. I mean, silver is a supply and demand mismatch that has a fantastic setup if you're patient and you have a longer time horizon. And for me, again, silver has seen 5 consecutive years of 200 million ounce supply deficits. And, by Silver Friday of this January, we were looking at $1 billion in silver deficits. And that supply crunch with that demand rising is a perfect setup longer term. We saw the LBMA seize up last October. There just wasn't enough metals to meet delivery. In New York, on the New York Exchange, whatever you think of it, and gosh knows I don't think very highly of it, you had a ratio of, the COMEX's registered silver, that's available silver for delivery, versus the open interest, which was the paper claim demand for delivery. You had a ratio of 7-to-1. At some point, and again, regardless of whether you're bullish or bearish or cynical or not, that supply and demand mismatch has to play out in normal price discovery, despite all the mechanizations we've seen on the COMEX, really since Trump was elected in November of 24 and into the first year of his term. The mechanizations we saw in December of 2025, and then again in January on Silver Friday when they were raising the margin hikes, all these efforts to manipulate the silver price because they had to raise margins because they didn't have enough actual physical gold to lever the paper price. So it was a fascinating moment. And I think these exchanges are really pacing towards a cash settlement only exchange. In January, we saw 20% of gold leave in a week of their available, of silver, of their available silver in a week. I think that was JP Morgan. You don't know, they don't have to report it. But the big banks were pushing the price down to get themselves out of a massive short squeeze where they were upside down to a survival level. And then once they pushed the price down with the margin hikes, they then were accumulating the metals. And so it is an insider game. We could spend hours on that, but there's no doubt that there was a need to save the banks and a bailout in January on the silver market in New York. They did these margin hikes that they've done many times in the past. Those mechanizations may seem too big to fail or too powerful to beat. I disagree. I think the COMEX and the LBMA markets in the silver space in particular are losing credibility as fast as they're losing actual silver. And I think you're going to see from India to the SPIMEX to the Shanghai Exchange, whatever you think of those jurisdictions or those governments, you're going to see fair price discovery, and you're going to see a point where supply and demand actually matter again, despite the paper trade. You could get into the technicals on the futures market. There was backwardization. The current prices were higher than the future prices. That always, for me as a technical trader, signals a higher demand and a supply shortage. And, when you look at the lease rates of silver, I mean, my whole career, they were never above 2%. They went well above 8%. In fact, they were usually less than 1%. So again, whether you're looking at it as a trader, and we're looking at it far more as a long-term play, as a monetary metal, you simply can't print more silver, just like you can't print more gold. And I think the military and industrial demand for silver is going to increase. I mean, silver, as many of your reviewers know, is a byproduct. It's a byproduct element, and 70% is byproduct mined. You just can't increase the supply with a button. You can't mouse click it. You can only play with the paper prices. And I think whatever we think of this war, which we can get into, or whatever we think of inflation or the deflation, crude at 100, and where's silver going to go longer term? Oil inflation is not the kind of inflation the Fed can fix. It's not the kind of inflation that can be cured. And for each $10 price in oil, inflation raises by 1.01%. But again, the longer inflation deflation discussion comes in for both gold and silver, but silver is going to outpace gold in that next bull run. It doesn't mean gold or silver go in a straight line. You could say silver's broken a lot of hearts, but if you bought it at 15 or 20 or 30, are you not entertained? Even with the pullbacks, if you are a long-term investor, you're not the least bit worried. If you're a trader or trying to get out and get into mining, you have to call it. I think at some point, we always think of gold, though, as the ultimate preservation asset, and silver, as Egon says, is not for widows and orphans. It can break hearts. But when you get to ratios, the gold-silver ratio, I think we're going to see new compression, new record compressions in the next real bull market in gold. And at some point, as we say, you'll make a very good return on silver. We don't like to price target because we're measuring that in fiat currencies. I'd rather measure silver and gold and how many barrels of oil it can buy, how much real estate it can buy, how much assets it can buy, not what the monetary price is in some fiat currency. But $300 silver, $400 silver, these aren't exaggerations. If you're playing the long game and you're not trading, it's just a question of when, because the fundamentals for the monetary system and for paper currencies haven't changed. And so silver will have its time. It's not as discussed. I'm glad you asked that question about silver first, because very few people do. But for the patient investor, not the trader, who understands the story or the narrative for precious metals in general, including gold, silver is still very much in the first innings. And again, we're selling our book, but it's an absolute conviction. We're not alone. And whether it's gold or silver, you got to watch what the banks and the traders are doing versus what they're saying. And you got to look at the supply and demand forces, which still matter. And you have to determine for yourself what your time horizon is. For any of us who bought silver, whether we bought it at 70, 60, 50, or 90, or 10 or 5, we're patiently waiting for that compression in the ratios. Probably at that point, when I see a gold-silver ratio in the 20s, 30s, or below, I'd sell some silver and just buy more gold. That's a long answer to a short question, but the short answer is we're very bullish on silver. Egon is particularly bullish on silver right now. And we're not alone. Outside of the commodities space or the precious metal space, a lot of equities and credit jocks are accumulating silver at pretty rapid amounts right now. And I think it's a Boxing Day sale for silver right now, if you understand its long-term play.
Hovering around 4,700 right now. Now, many expected gold to go ballistic when the war in Iran started, and yet gold has been down to sideways since the conflict began. Why do you think that is, and what is your overall assessment of the gold market at present?
Again, when it comes to the war, that's a rabbit hole. And of course, predicting the war, criticizing the war, praising the war, debating the war, I'm the last person to give an opinion. I'm probably the last person anyone wants to hear that opinion on. So I try to stay out of the armchair quarterbacking on the war and my views of it, or its duration, or its goodness or badness. We all have very strong opinions on that. What folks like I can do is certainly look at it economically, and not just in terms of precious metals. And again, you could spend hours on it. You can look at the parties of this war. You can look at the economic risks of this war. But I think, what we saw, and I've said this many times, it wasn't a necessary shock you would think if gold loves chaos, what can be more chaotic than a major military conflict in the Middle East at the Strait of Hormuz with a supply shock in oil? And why wasn't gold ripping? And the sad reality is there were sell-offs in in gold, not because it was a desired sell-off, but because it was a forced sell-off. And I did a lot of different reports on different countries like Turkey, which, has to import the vast majority of its oil and gas through the Middle East. When this war lasted more than 2 weeks and the last ships came through the strait in late February, there was an uh-oh moment in a lot of parts of the world. And Turkey's a classic example of having stacked gold religiously, metaphorically, but at a fundamentally meaningful level. They saw the writing on the wall for the lira and paper currencies, and they were stacking gold significantly prior to the war, had to sell 10% of their oil early on, had to sell 10% of their gold early on just so they could afford to buy higher priced oil. And they needed that oil to function as a nation. So that was an example of a forced sale of gold. Again, I keep confusing, a forced sale of gold to buy oil. But what was interesting, when Turkey did that, it was a swap through Switzerland. A swap, without getting into all the weeds, is kind of like a pawn shop. You can say, I'm going to sell you some gold, but I want to buy it back later. They did a swap for 10% of their gold holdings just to survive because the world survives on energy, despite what Greta Thunberg says. We need oil, we need energy. And so that was kind of a forced sale because they needed to sell gold to buy oil. On the flip side, you see a lot of the GCC countries, including Saudi Arabia, having to sell some of their gold, over 50 tons, we think, not to buy oil. Obviously, they have the oil, but they needed it to buy everything else because they import most of their food and other products. And so they had to sell their good assets, their most valuable assets, their most liquid assets that they didn't want to sell, to buy products. So you have two extreme examples of Saudi Arabia and Turkey, who are very fundamentally in favor of gold, forced to sell it because it is their most valuable and liquid asset. And if this war drags on, you could see that. So that was one clear cause. Those are large amounts of gold sales. And when you have large sell-offs, you have a price reduction. You also saw a lot of levered ETF, I call tourists in the gold space, that saw the all-time highs in 2025. And we're in levered ETFs, 2 to 3 times levered. Those rebalance daily. If you're a genius when gold is ripping, you look very less intelligent when gold is falling. Because they rebalance daily, there was massive ETF sell-offs. That was clearly another force on the downward pressure of gold during the fog of war. And of course, a lot of this, the shadow banks, the hedge funds, they're not holding gold as a preservation asset. They were trading it for arbitrage. They were very levered. They all track the same algo signals, the same stop loss signals. And when they hit those, they started to sell en masse as well. So between the institutional hedge fund smart money, between the ETF tourist trade, the speculators levered, and between the forced sales in the Middle East and other parts of the world to pay for other products, there was a sell-off in gold at a time when you thought it would rip. It's certainly not peak gold, and we can get into that, and there's a lot of reasons, but the sell-offs were not a shocking surprise. It's just like you see when you see the S&P get an uh-oh moment. It's not uncommon. It's a margin call. You have to sell the good to cover the losses of the bad, so your best assets are paying for the sins of your worst assets. And that, we talk to clients all the time, in the next uh-oh moment in the S&P, the Dow, the NASDAQ, if we see a retracement, you're going to see a likely sell-off in gold too. The question is, a sell-off from what price? If you're trying to time that as a trader, will gold sell off again? Will the market crash when gold's at 5,500, 6,000, 5,700? Nobody knows. If it's sold off today, of course, you would use that as a sale price. But if you're a long-term investor, and we're looking 10, 20 years out, whether you bought gold at 4,500, 3,800, 5,200, or 6,000, yes, of course, I would have liked to bought gold at 300 like Egon, but I'm still glad I bought it. I'm saying for the long-term investor, not the trader. I'm no help to the trader. For the long-term investor, we see gold at significantly higher prices than we do today. War confuses a lot of things. We're not panicking by sell-offs. In fact, most of us, and a lot of our clients, are buying in these sell-offs. But not everyone can afford that. Not everyone can think that way. And certainly if you're looking to get rich on gold, we're not the people to give advice or to trade on gold or to lever it. We're not the ones to talk to. But war has certainly confused a lot of things. It wasn't a shocker to see the sell-offs. We're not worried about it. I am much more worried about what the war will do to the markets and to the economy longer term as this war drags out. Again, whatever you think of it, most people are against it, understandably. As von Clausewitz said, war is an extension of politics by another means, but politics are an extension of economics. And the economics of this war, it is an oil war, it is a dollar war, it is a U.S. Treasury war, it is a petrodollar war. Again, whatever you think of the ideologies behind it, the economics of it are fairly simple. And the longer this drags out, the more stress it puts on the markets and on the economies of the world, recessions, market drawdowns, the inevitable fiscal and monetary stimulus to follow, whether it ends tomorrow or whether it ends in a month. That stimulus, that expansion of the money supply, that balance sheet expansion, and that moment is ultimately going to be a massive tailwind for gold over the many years to come. And as I'd like to say, we ain't seen nothing yet. And again, that's selling my book, but that's understanding history. And we're far, far, far from peak gold. Even I think the bears can expect that. And when you see Goldman Sachs or UBS or JP Morgan, especially at Goldman, the world's greatest investment bank, the massive bank we're all familiar with, when you see their head commodity trader or their CIO more bullish on gold than half the gold camp for year-end targets, I'm not a big fan of these banks. I'm not a big fan of the BIS. I'm not a big fan of central banking in general or commercial banks for a lot of different reasons. But I even have to agree with them. They're starting to see what they wouldn't admit years ago. So whether it's a gold bug, whether it's a bond jock, or whether it's a Goldman Sachs a commodity trader, we're all kind of aligned now on where gold is going longer term. I don't think anymore it's an apology for the metal.
How bad could this get? And assuming we do get an outright crisis in bond markets, what does that mean for broader financial markets and gold as well?
Well, Jesse, I've been saying for years that the bond market is everything, and it gets boring, and it is boring. Yields are boring. The inverse relationship between yields and bond prices, it take a few minutes to understand that. But yields represent the cost of debt, and everything is debt-driven. American growth is debt-driven. European growth is debt-driven. And when those yields rise, they're like shark fins, because rising yields just mean rising costs of borrowing, rising costs of debt. And debt is the wind beneath the rotten wings of the G7. And so these yields matter. As you talk about the gilt, the German Bund, the U.S. Treasury, they're all rising. What's interesting is the Chinese 10-year, or certainly the JGB's yields are rising, but the Chinese 10-year is compressing. That doesn't say that the world now prefers the Chinese 10-year. There's a lot of problems with the Chinese bond market, but it's fascinating. When you talk about the JGB, or the Japanese bonds, that's fascinating. They went nearly 30 years at near zero, and now they're rising. And as their yields are rising, well, that's the end of the Japanese carry trade and Wall Street's carry trade. It's a slow death by 1,000 cuts, but now it's becoming obvious. You can't just lever the yen, or you can't just lever the interest rates out of Tokyo to buy stocks in the U.S. We saw that a year or two back. That was a major moment, and now it's becoming normalized. What's also interesting when you see, and Japan and the U.S. are very similar but different in their bond markets. The Japanese bond market is owned primarily by Japanese citizens. The U.S. Treasury market is owned by the rest of the world. But you still have to look at these canaries in the coal mine. The yen and the DXY, or the dollar, they're going down as their yields go up. Again, boring stuff, but typically rising yields mean a stronger paper currency. But now the yen and the dollar are acting like banana republic currencies, like just another asset that can be traded as opposed to a major economic currency or global currency. I think in addition to watching these rising yields like shark fins, which are very destructive to everything, including equity markets, which we should talk about the stock market. But the bond market, those rising yields, I absolutely agree with Luke Groman and anybody, or Jeff Gundlach, or anyone who's traded bonds, which I did before I got into precious metals. It is everything. The smartest guys in the equity market were former bond traders because they knew that yields were the signal to go long or short, to be bullish or bearish. If the U.S. at 39 to 40 trillion in public debt sees yields at 4.7, 4.8 on the 10-year, the key bond, the 10-year, the U.S. 10-year, we get past 4.6, 4.8, 5%, we're looking at a disaster like we saw under higher for longer under Powell. You saw banking failures. Those weren't bank failures in 23. Those were bond market failures because that was the underlying collateral of those banks. you see a tightening of credit. Liquidity, the expansion or tightening of liquidity is everything. Yields determine whether there's going to be more or less liquidity. It has a direct impact on the stock market. It has a direct impact on the national government, because as yields rise, we can't afford to pay our own bar tab. We have to print more money to fight inflation we create more inflation. That's the fiscal dominance argument. So you cannot understate or overstate enough, what this boring thing of bond yields means. Those are rising, and those are shark fins to everything, to the national debt, to the U.S. economy, and to this U.S. stock market. And if you combine these rising yields at a time where we're seeing a net loss of jobs in 2025 and a national debt that's grotesquely outpacing our income, you have to remember that even before the war, the cost of interest on our debt, Social Security and Medicaid, was still 20% higher than incoming tax receipts. That was before the war. So when you have a national debt crisis, a national labor crisis, and a ticking time bomb overvalued stock market with rising yields, those are economic risk signals that I've never seen before. And again, you can say I'm crying wolf, and we can talk about why that still matters. And there's even a bull case for the markets if you print enough money. But I'm saying the fundamentals are so broken right now, and those yields are absolutely critical. Just if there's one takeaway, rising yields, the rising yield on the US 10-year in particular, that's the risk-free return, which is really return-free risk. The most sacred bond in the global economy doesn't really beat actual inflation. Its yields are rising, its demand is falling, and the cost of debt is rising globally because of that 10-year. When the cost of debt gets too expensive in a world that lives on debt, you don't need to be an expert to realize that's a bug looking for a windshield, Jesse.
Is it something else? Why does the broad market continue to grind higher, given not only the tremendous overvaluation by a number of different metrics, but this war in the Middle East as well?
Really, it is the question on everyone's mind who's looking at stock markets, of course, this complete disconnect, not only between the S&P and war, although if you look at the war dividend from World War I to Vietnam to World War II to Korea, stock markets tend to do very well during times of war. There's a dividend in there, and then they fall quite dramatically after the war. But I've also said cryptically that you could have a mushroom cloud over Cleveland and the markets would still rip as long as the central bank was accommodative or dovish or easing. And because the markets are no longer driven by earnings or price to earnings or cyclically adjusted price to earnings or book value, the markets, and this is very simplistic, are driven by the Fed. They're centralized markets. They're a matter of national security for tax receipts. It's our only good story. If the Fed is accommodative, you can literally track the markets Pavlovian. Lower rates, higher market. Higher rates, lower market. Broader balance sheet at the Fed, better market. Tightening balance sheet at the Fed, worse market. So the Fed is now the key lever. It's not even a dial. It is a switch for risk on or risk off. That's very dangerous longer term. And of course, we can get into other things like passive ETF flows from every 401k and IRA in the baby boomer generation. Every Friday, there's an allocation made. Doesn't matter whether the fundamentals are good. Even as money is leaking out of the system or the markets are losing value, there's always that influx. In a recession, that ETF passive Michael Burry shock thing ends, though, because then people have to start selling their IRAs, their 401ks, take penalties. But it is really a Fed-driven market. That's the most simplistic thing. And I hate to be that simplistic, but that's where we've come since 2008 in particular. It's just a Fed market, and that is that simple. But in terms of the case of the markets now, again, there's nothing a money printer can't solve. That is true. The markets every V-shaped recovery every drip can be a V-shaped recovery if we're willing to debase the currency and print dollars out of nowhere and expand credit through the commercial banks. That's possible to save the markets, but it will always be at the expense of the currency, without exception. In terms of this market right now, for years, the smartest guys in the room have just said, I don't understand this. I'm not trying to time it. I don't understand it. I'm out. That includes Warren Buffett. That includes Jeremy Grantham. That includes Jeffrey Gundlach. It includes a lot of very smart equity traders and bond traders. So it's not just the gold bug case of trying to scream sensationalism. No one understands this market in terms of fundamentals. But as a former hedge fund guy, and I say lottery ticket winner, I'm not nearly the Jeffrey Gundlach or Jeremy Grantham, although I've invested with them. As a former risk asset trader, in addition to saying the Fed is the market, what I want your audience to take away is the question they should be asking about these markets, not trying to time them, but to prepare for them, is credit and liquidity expanding or is it contracting? It's that simple. And clearly credit and liquidity are contracting right now. That should be a major red flag to anyone thinking they're going to get rich buying at these tops. Most retail investors, I hate to say it, everyone on Wall Street knows, they buy at the tops and they sell at bottoms. That's not trying to be condescending. They are the plankton to Wall Street's distribution whales. So please understand, just ask yourself, is credit and liquidity expanding or contracting? Clearly, if you take a little bit of time beyond just one YouTube interview, liquidity and credit are contracting. That's major bad news. You can look at the private credit illiquidity or the private equity illiquidity. Right now, you've got $15 billion of gated redemptions in private credit, and not to mention private equity. Moody's recently came out, just so your audience can say, I'm not just making this up. They can check this for themselves. The private credit and private equity funds are now borrowing money to manage liquidity needs. So they're adding leverage on top of leverage to get out of a problem that is not a solution. The Harvard Endowment can't sell its private credit book. You could literally do a whole show, Jesse, on the Harvard Endowment's mistakes since the 1980s, since Larry Summers, but that's a separate issue. But as one other canary in the coal mine, Harvard, the smartest guys in the room at the classroom and at the endowment, can't sell their private credit book. So they're actually taking out billion-dollar loans to cover their illiquidity in private credit. And the Fed is now investigating, whatever you think of a Fed investigation, Wall Street is repackaging crappy subprime private credit loans into asset-backed securities, which is exactly what they did with mortgage-backed securities in 2006, 2007. That didn't end well. That's a game. And you've got record margin loans right now, all-time leverage in the S&P. You've got a cyclically adjusted PE ratio at 39. You've got Palantir trading at 300 PEs. You've got a Buffett indicator of market cap to GDP at record highs. You've got the highest Wall Street overvaluation history. Does that mean you can time the needle or the event or the day of an uh-oh moment? No, but it clearly means you should be preparing yourselves to not be chasing these tops. That's my opinion on the market. The markets are hitting a distribution phase. And since last June, the smart guys, I don't say the smart, the inside guys have been dumping. They've been dumping since last June. And someone has to buy that dumping. So like Andrew Mellon in the 1920s, they'll be going around saying the economy's never been better, markets have never been stronger. Well, Andrew Mellon sold his entire book before the crash. Don't trust Wall Street and don't trust the private wealth management arms of the too big to fail banks to keep you all in this market. If you want to pick up quarters, dollars, and dimes in front of a moving train, that's up to you. They want you to. That doesn't mean I'm timing the market to crash tomorrow. There's so many needles pointing at this market and this overvalued market. And you've got to look at the volume. Again, if you're a trader, you'd be crazy to be bullish right now. That said, anything can be saved by an accommodative central bank. I think there's a moral hazard that many feel that now, if we have another '08 moment, it doesn't really matter because the Fed will save the market. There is some possible truth to that. Or we could have a 1989 Nikkei where there just isn't an ability to save that kind of loss, where the markets were down for 30 years and hadn't recovered. Japan is like a time machine. It stopped in 1989 when you walk through Tokyo. So if you want to believe the Fed will save you, that's a personal choice. Technically, they can, but they'll be doing that at the expense of the very currency you measure your returns in. So you're running uphill in roller skates, in my opinion, which is why we've always favored gold as a major allocation. But technically, you could save any market crash with trillions of mouse click dollars, yen, euros, Swiss francs, Australian, Canadian, American. You could technically save it, but my God, nothing comes for free. That's no free lunch. But the headlines we're seeing in private credit are eerily reminiscent of the pre-08 headlines I was starting to see in subprime mortgages. It's about the same market cap. It's major over-levered. We have 10 times more notional derivative trades today than we did pre-08. We learned nothing from Dodd-Frank. Is it a derivatives bubble, which is 4 times global everything? Is it a subprime credit market? Is it private credit and private equity? Is it a black swan that we can't imagine coming out of the headlines in the Middle East? I can't time or predict that. What I'm saying is the ice has never been thinner to have so much risk weight put on top of it. I just ask people in the markets to be far more cautious than what their advisor is saying down the street, whose entire modus operandi is to keep you all in all the time in the markets and to ask you to bite a stick in the next drawdown because it will recover. If it does recover, it'll be at the expense of your currency, or it may not recover at all because, like 89 Nikkei, it's just too big to save. At that point, the blood in the streets is too severe. I don't know, but there is no easy solution. There is no miracle left, and no one's going to save you. So you have to have dry powder and buy when there's blood in the streets, but dry powder and cash means it's eaten by inflation. You could buy short-term treasuries. You could put it into silver and gold and then go long when you see P ratios in single digits, not triple digits. It's common sense, but very few people do that. It's very sad.
Some great thoughts. Matthew, tell us about Von Greyerz AG and anywhere else people can go to follow your work.
Yeah, Von Greyerz, we're based out of Zurich. We're all about the fundamentals of gold as a wealth preservation asset. You know, for us, it's not that gold is rising, the dollar is falling. Since 2000, gold is up 1,580%. The US dollar is down 99%. Since 1971, the US dollar, in terms of what it can buy with gold, is down. It's down 96% with oil. It's down 89% with copper. It's down 76% with wheat. What we're saying is gold isn't rising. Your dollar and your paper currencies are getting weaker because of the debt sins. And our thesis has been the same for decades. You need to have a sizable allocation to a store of value in a jurisdiction that has a political and economic stability and a protection and a gold hub protection for those assets. You need a legal firewall between yourself and your government because I think capital controls, yield curve controls, financial repression are coming. So we are really, I'd say, evangelical, and we have been for decades, about gold as a store of value, not as a speculation trade, not as a get-rich trade. All of our articles and interviews can be found at vongreyerz.gold or vg.gold. We have a whole section on not just why gold, but how to own gold. That's for free. Our minimums are very high, so it's for a wealthier clientele. That doesn't mean our advice on the metals can apply to everyone. We really are sincere about that. There are so many articles. We've got advisors like Ronnie Sturfla from the In Gold We Trust report. We've got Alistair McLeod as an advisor, myself and Egon, a brilliant young new partner, Johnny Haycock from the banking system, is very eloquent on gold. So, you know, there's a lot of free information there to understand the space. And we think everyone has to be informed, whether you're a client or not. So there's decades of information there. And of course, Egon is an icon in the space. He saw this well before us, but we always saw debt risk, currency risk, historical risk, military risk, and banking risk is inevitable. And here we are. They're culminating right now. It's not the end of the world, but you have to be prepared for the monetary system changing. And our website gives you a lot of that for free.